Okay. So who was the person who emailed me and asked me where Paulson was? So you've been coming to UC 50 all these weeks and you didn't know it was called Paulson. So now you do. Okay. So I'm glad it was a benign explanation, because that's, when you said you're NYU Shanghai, I decided, because the other reason you might not know where Paulson is you've never been to class yet, which would be a not that good a scenario. So I'm glad it's a better scenario, because I've seen you in class all the time. Okay. So let's talk about what this quiz will cover. Right? Slides 1 through like 140 something in lecture note packet 2. Having said that though, it's a little deceptive, right? Why? Because remember in quiz 1 we levered and unlevered betas. If you had trouble doing that, this quiz is still going to be a problem. So it's non-cumulative in the sense I will not ask you a bottom-up beta question. But if you really don't get what we did in quiz 1, it's going to be an issue on quiz 3. Quiz 1 more than quiz 2. Quiz 2 is kind of self-standing. It's more accounting earnings, cash flows. This is really about did you get quiz 1. So if you're still shaky about quiz 1, my suggestion is you revisit that. Because here's what this quiz is going to be about. Here are the questions I would like you to be able to answer. And the quiz is directed at basically seeing if you can answer them. The first is, there is a trade-off in debt. There are pluses and minuses. Can you go through that trade-off? So in a sense, do you know what makes debt more attractive, what makes it less attractive? Second, can you estimate the optimal debt ratio for a company using the cost of capital approach? Presumably you've done this for your company on your project, but what are the mechanics of doing that? So we're going to talk about that. Third, once you've come up with the optimal, how do you move to the optimal? You buy back shares. What's the process of doing that? So there are a whole set of mechanics there. And finally, can you tell me how matching up debt to your assets helps you, and whether your company has a mismatching problem? So those are the 4 fundamental questions. Let me take each one. The first one actually is the trade-off. We talked about the trade-off in debt is a very simple one. There are 2 big benefits. There's a tax benefit, and the fact that if you borrow money, it might make you more disciplined as a company in how you pick projects. So the first argument is a pure tax argument. Interest is tax deductible, but to get the tax savings though, what do you need to have? But you need to have, so interest expense saves you taxes if and only if you have income to cover those interest expenses, right? And in fact, there are a couple of quizzes where I push you on that, where I tell you what the interest expenses are, I tell you what the operating income is, and the interest expense is actually higher than the operating income. And what I'm checking to see is whether you apply a tax rate as if you're going to be, the IRS doesn't mail you a check for interest expenses. It looks at what you have as income. So only if you have income, but if you have income, interest provides you tax advantage. So if you're a money-losing company, debt doesn't give you an advantage, because interest is not going to save you taxes, at least for the moment. On the other side of the ledger, you have 3 basic costs. The first is a bankruptcy cost. That comes from the fact that as you borrow more money, you have more interest expenses to make. And to the extent that your earnings are volatile, you have a greater chance you will not be able to make those payments than you did have before you borrowed the money. That's bankruptcy cost. And of course, once you default, you go into the court system and there's this direct cost of bankruptcy. But even before you default, there is the perception that you're in trouble, which can actually put you in trouble. In what sense? The perception you're in trouble will mean that your customers stop buying your product. That's the indirect bankruptcy cost. We dealt with that actually explicitly when we used the APV approach, but implicitly it's built into our cost of capital approach when we lower the operating income as the ratings change. The second cost is an agency cost. The agency cost arises because what's good for equity investors is not always good for lenders. And now that you have both groups in the same company, they're going to push against each other, which creates covenants and legal costs and basically puts you in a straitjacket if you're a company, if you borrowed money. And the final cost is every time you borrow money, you give up some future flexibility. It's nice to have some debt capacity in case you need it. So that's a trade-off. So I could frame a question around this trade-off. I'll give you an example. Right now, there are all these politicians running all over the country saying they're going to rewrite the tax code. Let's assume that they tell you that one of the things they're talking about is they're going to allow companies to deduct dividends. Right now, you can deduct interest expenses to get to taxable income. But let's say they say they're going to allow companies to deduct dividends as well to get to taxable income. How will that change the optimal debt ratio you have for companies. Yes?
It will be a smaller ratio because equity will also give the tax benefit.
In other words, the net benefit of debt will get smaller because now instead of debt having all the benefits and equity having none, you have to look at the net. This is very similar to what Brazil has in its tax code, where equity is given a partial advantage. What that will require you to do is to think through the consequences, the trade-off, and say, this is what I think will happen. Okay? Let's assume a different politician comes along and says, no, that's giving away too much to companies. And he suggests a different rule, which is that you'll be allowed to deduct interest expenses, but only up to a certain amount, up to 50% of your operating income. And if you get above 50%, you're no longer allowed a tax reduction. Now what will happen? What have I done if I put a cap on how much you can deduct as tax benefits? Now it's not even whether your operating income is high enough, it's whether you get to 50%. Once you get past 50%, what happens? Your tax benefits go away. You will borrow less money than you did before this tax law passed, because now I've reduced the tax benefit to debt. So think about that trade-off, because you can take almost every public policy issue and think in terms of that trade-off, because it is going to affect that trade-off. Here's the third one, and we'll leave it at this. Let's assume that a really big company, a company that's too large to fail, that has borrowed money, is on the verge of bankruptcy. The government steps in and bails out the company. So it prevents bankruptcy. What effect will that have on optimal debt ratios of companies? It's just one company, right? Yeah. And tell me the rationale. Tell me why.
They're safer in taking risks.
Why? What are they reading into that bailout that's leading them to believe they're safer?
Lower bank risk.
No, don't jump yet, because
Banks, when they borrow money, they do implicit risk.
there is an implicit assumption that if you did this once, you're going to do it again. In fact, I'll go further. What kinds of companies are going to view this implicitly as a reason to go out and borrow money? Large companies or small companies? Large companies, because too large to fail. So in a sense, what you're going to have is the minute you bail out one large company, you can almost guarantee that other large companies are going to borrow more, because they now say, look, when you borrow more, you get the tax benefits of debt, and if something goes wrong, the government will implicitly come in and bail me out. It's a dangerous assumption, because the government might not. But now you can see why governments have to be very careful about stepping in to protect individual companies from the consequences of borrowing too much money. So play a few games, take that trade-off and ask what-if questions, see if you understand what the pluses and minuses of debt are. Now let's get specific. The tool that we've used almost all the way through this part of the process to look at capital structure is the cost of capital, right? So let me very quickly review the numbers that go into the cost of capital. The cost of capital is a weighted average of the cost of all of your different financing, and we define financing as coming from either equity or debt. The cost of equity is the rate of return that marginal investors in your stock demand for investing in your equity. So it's going to come from your risk-free rate, which you choose based on your currency. The beta, because you're looking at only the risk you cannot diversify away, and an equity risk premium based on where you do business. The beta that you use, though, has to be consistent with the debt-to-equity ratio and the cost of capital. I'm going to say that very emphatically, because this is the one thing that you're going to have to come every problem. This is going to be part of the promise, recognizing that if you change the debt ratio, your cost of equity will change. Why? Because your equity gets risky, and we capture that through a levered beta. The cost of debt is the rate at which you can borrow money long-term today. So I could give you a cost of debt from 2 years ago, 5 years ago, 7 years ago. You should just ignore it. It's irrelevant. The only thing that matters is what you can borrow money at today. So to get there, you're going to start with the same risk-free rate you started your cost of equity with, but you're going to add a default spread. What's that default spread going to capture? The perception I have that you might not pay me, which comes from your credit risk, which I might cheat and look at the rating you have as a company if you're rated. And if you're not rated, I have to do my due diligence and attach the equivalent of a synthetic rating. So that's my cost of debt. I do get a tax advantage. And the tax advantage here is going to be captured by the marginal tax rate, because interest saves you taxes at the margin. The weights, of course, are market value weights in coming up with the cost of capital. So file that away, because here's what we have to remember about market values. If you have a publicly traded company, the market value of equity is easy. Share price times number of shares. If you have two classes of shares, make sure you count both classes of shares. But if you have debt, it gets a little messier because for most companies, at least some of the debt is not traded. So all you have is a book value of debt. And we talked about how to convert book value to market value using a very simple trick. The trick, of course, is to treat the debt as if it were a corporate bond or a bond. The book value of the debt becomes the face value. The interest expense becomes like the coupon. The weighted maturity of the debt becomes the life of the bond. You take the present value. Using today's interest rate, you've got a market value for the debt. And don't forget leases. If you have lease commitments, you've got to bring them into the debt because they're part of your debt if you're a company. So I'm going to go back a couple of years and take a problem that gave people a lot of trouble because they missed 3 key words. And let's see if you can get what those 3 key words were which allowed you to crack open this problem. It's a company which has 15 million shares outstanding, trading at $10 per share. And I said the book value of equity is 50 million. Now you're saying, why do I need a book value of equity? There's a part of this problem where I will need the book value of equity. There's a part of the problem where I will not need it. So I've given you both a market value of equity and a book value of equity. Book value of equity is 50, market value of equity is 150. So that was easy. Then I tell you about the debt. It's a little messy. They have a $50 million bond outstanding with a coupon rate of 7%, trading at par. Remember I said there were 3 words in this problem which if you missed this problem was almost impossible to solve? Those were the 3 words, trading at par. What does that mean, trading at par? Trading at par means you're trading at book value. The only conditions under which you trade at book value is if the coupon rate is equal to the market interest rate. In a sense, I've given you the cost of debt. The coupon rate for that bond. Usually coupon rates can't be used as a cost of debt because you're not trading at par. Okay? That trading at par gives you the cost of debt. Then I go on and I say this company is an old bank loan. Key word is old. Bank loan. With 5 years left to maturity, an 8% stated interest rate, which was set when? Whenever you borrowed the money. So it's an old interest rate. And a face value of 50 million. So essentially, I can't give you the market value of that loan because it's a bank loan. It's a $50 million loan. You took it a long time ago at 8%. Is your cost of debt 8% now? Now that I've thrown you a second, why can't you get a cost of debt from that second loan? What did I say the cost of debt was? It's the rate at which you can borrow money today. That was the rate at which I could borrow money. When I took that bank loan 3, 5, 7 years ago, it is not going to be a cost of debt, but it is the rate at which you borrow that money. It's like a book interest rate. Okay? The firm also has operating lease expenses of $10 million for the current year and has commitments to make those same lease payments every year for the next 7. Please, 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 by now you should be able to compute the present value of an annuity using the annuity formula. I don't want to see 10 numbers and you discounting each one separately and adding them all up. First, it freaks me out, all these numbers on that page. Second, it should freak you out because you're wasting time you don't need to spend. So if you're still struggling with whether in fact you know how to use the payment function in your financial calculator or the present value equation on it, get over it, at least over the weekend. So if you have a lease payment like this, you have an annuity for 7 years, use the annuity formula. The firm's current beta is 1.20. No, they remember. But when I talked about betas on quiz 1, I said if I don't specify otherwise, whenever I talk about betas, am I talking about levered betas or unlevered betas? Levered betas. It's always levered betas. If I want to talk about unlevered betas, I will be specific and say this beta is an unlevered beta. So that's a levered beta. 1.2. The T-bond rate is 6%. The market risk premium is 5.5%. And I also tell you, the company has earnings before interest and taxes of 40 million after operating lease expenses and has a marginal tax rate of 40%. So let's do this problem piece by piece. First question, the first part of the problem, as I think part A said, estimate the market value of the debt. Now remember, there are 3 pieces to this debt, right? There's a corporate bond, there's a bank loan, and there are the lease commitments. Let's take the easiest one first. What did I say the corporate bond was? It was trading at par. So that's the easy part. That's a 50 million in debt. which is also the market value. Why? Because it's trading at par. Market value is equal to book value. Now let me take the bank loan. I have a $50 million bank loan. The interest payment on that is $4 million a year. You see where I get the $4 million? It's the 8% coupon rate. I have 5 more years left on the loan. So I have $50 million every year at the end of 5 years, $4 million for the next 5 years. I know my cost of debt is 7%. You can't have a company have 2 costs of debt. So you can't say at this moment, say, I think my cost of debt is really 8%. It's 7% because the corporate bond tells you what the cost of debt is. I've computed the present value of the coupons and the present value of the 50 million in 5 years at a 7% rate. The value that I get for the bank loan is $52 million. Now when you're doing these calculations, there's a very simple way to check to see if you've gone massively wrong. Why is my market value higher than my book value here? My coupon rate, 8%, is higher than my market interest rate of 7%, right? So here's a very simple indicator. If your coupon rate or book interest rate is higher than the market interest rate, your market value should be higher than the book value. If it's less than the market interest rate, your market value should be less than the book value. In fact, if you're in a real hurry, you don't have the time to do the present value equation, I'll give you a little trick you can try. It's not going to give you the right answer, so you're going to lose some points, but at least you'll be on path to getting most of the credit. If this were a perpetual bond, the market value of this bond will be the book interest rate divided by the market interest rate, 8 divided by 7 times the 50 million. So in other words, if you said, look, I don't have the time to compute the market value of this debt, but I know the market value should be higher than the book value, try that approximation out. You're going to get like 54 or 54.5 million, which is higher than the 52. And the longer your maturity, the closer the numbers will get. So if you have a 15, 20, 25-year bond, that shortcut is going to give you the market value. So that's the market value of my bank loan. So I've got 2 pieces done, then I turn to my leases. My leases, I owe 10 million a year every year for the next 7 years, right? I discount those back at the pre-tax cost of debt. Remember why we use pre-tax? Why do we use pre-tax cost of debt to convert lease commitments to present value? Because they're pre-tax commitments. I haven't done any deductions yet. Because it's a pre-tax lease commitment, I use the pre-tax cost of debt. The present value of 10 million a year for 7 years is 53.89 million. I add the 3 numbers up. The total value of my debt, including the lease commitments, is $156 million. So in this problem, you actually had all 3 kinds of debt, right? One was a corporate bond, one was the bank loan, one was the lease commitment. I've converted them all into debt. I use that to come up with my debt ratio. And here I have to stick with market values. My market value of equity is 150 million, which means my debt ratio is 51%, and my cost to capital is going to be the cost of equity is the risk-free rate plus beta times equity risk premium. So we've gone over that multiple times. Times 0.49% plus the 7%, which is my cost of debt coming from that trading at par statement, times 1 minus the tax rate, times 51% gives me a cost to capital of 8.32%. Any questions on the mechanics of what we did there? So make sure you convert book debt to market debt. Make sure you use market value of equity. And then the rest of the process is pretty much following the mechanics. Okay? Yes?
So if you give it a market interest rate either by trading at par or if you just give it...
There are 3 ways I can give you a market interest rate, right? Actually 4. The first is I can say the market interest rate for this company is 9%. If I'm feeling really generous, I might do that. In which case, just use the 9%. The second is I can give you a rating for the company and say the default spread that goes with this rating is 3%, in which case you take the default spread, add to your risk-free rate, you got the cost of debt. The third is I can give you a bond like I did and say trading at par, trading above. In fact, let me ask you a question. In this problem, if I'd said this bond were trading at 10% above par, what would you have needed to do to get the cost of debt? Because then the coupon rate can't be used as the market interest rate, right? What would you have needed to do? You'd have had to compute the yield to maturity on this bond. Do you guys remember how to do that? Okay. So maybe you should brush that up during the weekend, right? Yield to maturity is, if you have a YTM button on your calculator, this is just a question of wrestling with your calculator long enough till you figure that out. But a yield to maturity is just an internal rate of return. You enter the coupons, you solve for the R, That's yield to maturity. So the coupons would have to be 3.5% because it's 7% coupon. The price would be 110 if it's a 10% above par, and you'd solve for it. But that's the third way. You know the fourth way is? I gave you an EBIT, right? Say I gave you an interest expense. And then I gave you a table, a lookup table. Then what did you need to do? Compute the interest coverage ratio, go to the table, look up the rating, look up the spread. So, you know how you talk about separate degrees of separation? I can separate you from the cost of debt by 1 layer, 2 layers, 3 layers, but I have to give you clues. You're not Gretel from Hansel and Gretel, right? I throw breadcrumbs and you find it. I've got to make it something more permanent. I have to give you a way to get to the cost of debt. If you look through the problem and you cannot find a cost of debt, then either I've screwed up big time or you're looking in all the wrong places. Okay? So make sure that you look for all possible clues. Don't get caught up in one particular way in which the cost of debt is given. In fact, write it for yourself 4 different ways, right? So that you can see it so as you go through the quizzes, you'll actually see it in different forms, in different problems. Just be familiar with all of them. Question? Yield is different from yield to maturity. Yield is just coupon divided by the market price. It's not the same thing as yield to maturity. So yield to maturity is always an IRR for a bond, whether it's 5, 10, 15. And that's why you should always use the yield to maturity, because if you're using yield, you're actually acting as if the face value is not an issue. So, yeah.
Yeah, so for the first bond, we have a yield of 7%, right?
No. The yield to maturity of 7%. That's why I have to do the present value. If the yield were 7%, so if I divided 4 by 52, which is what I got as my market value, I'm not going to get 7%. So I got the market value of the bond to be 52.05. Dividing 4 by 52.05 is not going to give me 7%. So the yield will not be 7%, but the yield to maturity will be 7%, which means that I've got to compute that IRR including the face value. Okay. Now, the next part of the problem, I asked you what the return on capital for this company was. Remember, that's fair game too, because that was part of that previous, when we talked about computing the return on capital for a company. The return on capital is the only place in finance where we use book values. So in a sense, you've got to forget everything you did in the previous page and go back to book values. Okay? So here's what I did. I took the operating income, but then I had to remember that because I capitalized leases, remember I converted operating leases to debt, I have to then fix the operating income. Fix it in what sense? The operating income as it's reported now is after operating lease expenses were treated as operating expenses. And I've said I'm not going to do that. I'm going to treat it as a financial expense. There are 2 ways you can get to the adjusted operating income. One is to do it right. Doing it right would mean adding back the entire lease expense, which is $10 million, and subtracting out the depreciation on the leased asset. I'm going to give you a shortcut, which I'm okay with at least for this quiz. What I did was I took the $40 million, the stated operating income. Remember the 53.89 that I got as my lease debt? I said if that had been debt, the interest expense on that debt would have been 7% of 53.89 million. Think of that as the interest expense you'd have had if this had been treated as debt. And this is earnings before interest and tax. I add that back, I get an adjusted operating income of 43.77 million. If you did it right, which is to add back the lease expense and subtract out the depreciation, you'd have got 42.3 million. So I add the 10 million and then I subtract out the leased asset by the life. But either way I'm okay. That becomes my after-tax operating income. The book value that I use in the denominator is the first 50 is the book value of equity. Lots of 50s in this problem, so it's easy to get confused. The first 50 is the book value of equity. What are the other 2 50s? One is the book value of the corporate bond, which happened to be market value. The second is the book value of the bank loan. Here I'm reverting back to book value because it's a return on invested capital. And the third is leases, for which there's no book value. So in a sense, I've created a book value equal to the present value. My total invested capital is 203.89. My return on capital is 12.88%. So if you think about return on capital, that's what's driving it. And as I said, this is the only place where we use book values in our calculation. Yes?
Why are you using the book value for 250s and then you're not using it for the operating?
Because there is no book value. It's an asset I created, right? So, in a sense, if I had a book value for leases, I would, because you, and in capital leases, you would, right? Because there is a book value. Here, because it's an asset I'm creating out of nothing, I have no book value to replace it with, so I essentially have to use the market value as a book value. Okay. So now let's talk about the second piece. And this is usually the biggest part of every single quiz, where I take a problem and I say, what will happen if you change your debt ratio? I don't think there's a single problem where I've actually asked you to compute the optimal debt ratio for a company, because that will mean going 10%, 20%, 30%, and that's going to be too difficult to do. So usually I'll give you the existing debt ratio and the numbers to compute the cost of capital. That'll be part A of the problem. Then in the second part of the problem, I'll throw something at you. I'll say, not physically, but in the problem, say, in this second part, assume that they go out and borrow 3 times more money and they buy back shares or they pay a special dividend. What will happen to the cost of capital? So the mechanics of what I'm going to do on this problem are exactly the same mechanics I've done on almost every problem too, on every past quiz. Okay. In fact, it's a problem I have the most trouble writing, because I've written the same problem so many different times that I have to think of ways in which I can make it look different without it being different. Okay. So let's in fact look at what this process is. The first and most forgotten part of this process is when you change the debt ratio, your cost of equity will change. And here's what you need to do. I give you a beta today at today's debt ratio, right? First thing you need to do is unlever the beta. You're going in the wrong direction. You're saying, I want to borrow more money. Why are you taking? Because I need to know what the unlevered beta is first. And once I have the unlevered beta, you can put in your new debt to equity ratio, the new debt, and come up with a levered beta. So that will give me my cost of equity at the new debt ratio. For the cost of debt at the new debt ratio, if you are starting from scratch, here's what you need to do. You need to compute the interest expense you would have at the new debt ratio. You need to use that interest expense to come up with the coverage ratio at that debt ratio. Go to a lookup table and come up with the rating, come up with the cost of debt, and then hope and pray that the rates are the same. And if they're not, you'd have to do it again. I think there was one quiz where I actually made you do that. But that's all the problem was, is coming up with the cost of debt, and I'll go through that problem. But in most of the quizzes, I kind of did a short, because I know you have 30 minutes, rather than make you compute the rating at the new debt ratio, I'd say your rating is AA now, but if you go to a 50% debt ratio, your rating will drop to BBB, and all you have to do then is use the new default spread based on the rating. Your cost of capital at the new debt ratio will be a weighted average. So let's see how this will work out. Let me give you the one problem where I actually made people do part B, part 2 explicitly. About 10 years ago, I gave the 10% debt ratio. And in the 20% column, it was actually blank. So basically, I asked you for the 20%. So in the quiz, that second column was missing. So I've actually filled in the numbers. But I'm going to go through the process, which we did in class as well, of how you'd have filled out the second column. So all you had was the 10% column. So act like the 20% column is not available. Let's go through number by number, and let's see if you can fill in column 2 if it had not been filled out for you. So at the 10% debt ratio, I have $1.5 billion in debt, right? I go to a 20% debt ratio. This isn't rocket science. I should have twice as much debt. So 1,500 times 2 is 3,000. That was easy. Then I gave you EBIT at the 10% debt ratio. Now when I go to a 20% debt ratio, how come the EBIT doesn't change? In fact, this is something we did. But I borrow all this money. When I borrow that money, why isn't it going into projects and creating income? Because shouldn't that 1.5 billion be creating more operating income?
Assuming that the recapitalization is not affecting.
And when you say recapitalization, be more explicit. What am I assuming I'm doing with the 1.5 billion new debt? Or paying a dividend. Basically, that's the central assumption behind all of these optimal debt ratio calculations. That's why I can go from 0 to 90% debt, and my EBITDA, my EBIT remain exactly the same at every debt ratio. You probably saw that in your spreadsheet and kind of let it fly past you, but that's what I'm implicitly doing to keep those things constant. So that actually makes your life simple. The EBIT stays the same. Initially, remember, you don't have the rest of the column. You don't know what the interest rate will be at a 20% debt ratio. So here's what I did. I doubled the interest expense. I had the 10% debt. I have twice as much debt. Why not twice as much interest expense? It's patently unrealistic. Why? Because if I go to the bank and I borrow an extra $1.5 billion, the bank is not going to charge me the same interest rate they used to charge me. They're going to raise my interest rate because I'm more default risk. But for the moment, I act like I don't know what that rate is. I come up with $240 million. I divide the EBIT by the interest expense. I come up with a coverage ratio of 4.17. And in the quiz, I actually gave you the lookup table. This was part of the problem. And with a 4.17 interest coverage ratio, my new rating is, look down, so triple B. And my new default spread is 2%. So I went back and I had to redo my cost of debt and increase it from 8 to 9%. And I have a problem. Do you see what my problem is? When I computed the interest expense, I used an 8% rate, which is the old rate. Now I'm saying, hey, I made a mistake. It should really be 9%. So, in fact, I was very helpful. I actually said extra column in the quiz just to show you that don't stop after 20%. You're going to have a problem. In the extra column, here's what I did. I took the new cost of debt of 9%, multiplied it by my dollar debt of $300 million. My interest expense goes to $270 million. Interest expense goes up. My interest coverage ratio decreases. Then I very slowly turn to the next page and I check the table. Thank God. Or just thank me. Right? Because I could be really cruel and make you go to another debt ratio and do it. Then I'll show you second column. So I wouldn't be that cruel, would I? Probably not. No. So if you find yourself doing 7 iterations or 8 iterations, something's gone wrong in your calculations, you might want to revisit what you're doing. But that's my new cost of debt. I'm done. Why am I done? Because the interest rate I used is equal to the interest rate I claim you will have. My cost of capital is a weighted average of my cost of equity and cost of debt. You know, the biggest mistake people made on this problem was most of them got the cost of debt. They adjusted it. They were so caught up in doing the cost of debt and the interest coverage ratio. Here's what they did with the cost of equity. They basically took the cost of equity of 12.83% they had at 0% and left it at 12. They were so busy in the cost of debt calculation. And you know what you need to do with the cost of equity, right? What do you need to do to get the new cost of equity? You need to take that beta, unlever it, and then re-lever it back up at the new debt to equity ratio, which means your cost of equity will also change. The cost of capital is a weighted average of the cost of debt and the cost of equity. So that's the only problem I think where I've done this. And if I do it, it'll be isolated. It'll be one debt ratio and one interest expense. And it's really about making sure that you get going through the process and you remember things like your EBITDA doesn't change, your EBIT doesn't change. It's all about isolating the effect of interest expenses. Yes?
In this slide, from the second column to the extra column, the cost of equity doesn't change, right?
Yeah, because the debt ratio is still 20%. So once you get to the 20%, you've adjusted the cost of equity. Any change in the interest expense is not coming from more debt. It's coming from the existing debt being, having a higher interest rate. So cost of equity, you're done because it's all based on the debt to equity ratio. Right? Now, in many of the second problems, there is a part of the problem which actually requires you to take the next step, which is why are we doing all of this? By going to the new debt ratio, we lower our cost of capital, right? But then we said lowering the cost of capital creates value only to the extent that you can compute how much your value goes up by. So I'm going to set up the basic framework. When you go from one cost of capital to another, 9% to 8.5%, 8.5% to 8%, you're in a sense saving money each year, because one way to think about the cost of capital is this is what you're paying each year to run your business. So if I have a lower cost of capital, think of that as a cost savings each year. And to the extent that this is a permanent change in your cost of capital, you're going to save that money in a sense forever. And there are two ways these problems will be written. Either I will tell you assume no growth forever, which means your savings this year will be the savings essentially every year. Or I'll say assume a 3%, 2%, 5% growth forever, in which case you have to use a growing perpetuity. You're converting that annual savings into a present value. So that's basically the key to these problems, is computing that savings. The savings are always based on what your existing firm value is and how much your cost of capital changes. So don't write this out as an equation. I know you have these sheets you write out big equations, hundreds of equations. Just remember it intuitively. It's the savings because the savings continue over time. This is the present value. So let's then take the next step. Let's assume you come up with the increase in value. The next follow-up question is, what does it mean for me as a stockholder in this company? And I'll give you the three possible ways the problem can be framed. In one set of problems, I say assume that the buyback price happens at a fair number. What the heck is a fair number? Here's my definition of a fair price. If I pay a fair price, you should be indifferent between selling your shares back and not selling your shares back. The people who sell their shares back and the people who don't sell their shares back should all get the same share of the increase in value. It actually makes your life incredibly easy, because that means you can take the change in firm value and divide by the total number of shares outstanding, because everybody gets an equal share of the spoils. Even though you know that some of those shares will be bought back, you act like you use the total number. That's the fair price. The problem could also be phrased, what if you could buy the stock back at the old price? That's a completely unrealistic assumption, but let's say you could do that. Then you can actually buy back the shares first, because those guys are so stupid, they're selling the shares back at the old price, reduce your number of shares, and then you get the entire increase in firm value divided by the remaining shares. And of course there's a third solution, which is like an intermediate solution, which is, if I pay any price other than the fair price or the old price, I have a two-step process. First, I have to compute how much of my value increase goes to those people who sell their shares back by looking at the price you paid back, and then look at whatever's left over for you, the remaining shareholders, and divide by the remaining shares. Enough with the abstractions. Let me give you a very simple example from a couple of years ago. So in this problem, I give you a company, I say it has 10 million shares outstanding, trading at $25 per share, and $500 million in debt. So what's the firm value of this company? I threw that word out specifically. What's the value of the firm? $300. It's a very common mistake in this problem. $250 million is the value of the equity. $300 million is the value of the firm. Why? Because you've got to add the debt, the total. Think of it as a balance sheet, right? Debt plus equity. So $300 million is the value of the firm. The cost of capital is right now is 11%, and if you recapitalize by going out and borrowing $100 million, buying back stock, you can expect the cost of capital to drop to 10%. Is everybody with me so far? So if you do this, your cost of capital drops. So let's pause right there. If I do this recapitalization, how much am I going to save each year? My cost of capital drops by 1%. My value as a firm is 300 million. 1% of 300 million is 3 million. So that's your annual saving. Then I say, assume that this savings will continue not only forever, but will grow at 5% a year forever. So the present value of the savings is going to be pretty large, because I'm going to have 3 million growing at 5% forever. Yeah. Yeah. Otherwise, you're going to be stuck in this no man's land. If you want to do it for 10 years and make it 2%, you can do it all in, I won't take points away, but to the extent that this is a freebie that I've thrown out there, take it. Right? So here's what it is. So I take the savings of 3 million a year. If I save that money growing at 5% forever, it's a growing perpetuity. The present value of a growing perpetuity is that 3 million, and the savings are already next year's savings. That's why I don't have to put a 1 plus g, which you usually see in these equations. And if you do put a 1 plus g, I'll let it pass, but you don't need it here, because the 3 million is already next year's savings. Divide by 10%, which is the new cost of capital. And remember to do that. When you compute the present value, you do it at the new cost of capital, because that's what you're going to have after the recapitalization, and the value increase you get is $60 million. I'm almost home. The problem didn't say, the problem asked what price would you buy the shares back at, and it didn't specify any, whether it's a fair price or not. I let you make that judgment. The easiest solution is to assume a fair price. Nothing is specified, assume a fair price, because if you assume a fair price, you can divide the 60 by the 10 million shares outstanding, which is the total number of shares. The increase in value would be $6 per share, and the value, the new value per share will be the 25 you had before plus the $6, which is $31 a share. Sometimes after you do these problems, you say, well, can I check to see if I got the right answer? Here's a way you can check the answer. Remember the value that you had for the firm was 300 million? After the recap, that's going to go to 360, right? After the recap, how much debt are you going to have outstanding? 150 million. You subtract out the 150 from the 360, you come up with 210 million. And remember, after the recap, here's what you're going to have as number of shares. 10 million shares was the original number of shares. You bought back shares at $31 per share, and you bought back 100 million. The number of shares outstanding is 6.774. You divide 210 by 6.774. That's your answer. So if you want to double check your answer, that's one way to do it. It's actually work out the value of the firm, subtract out the debt, divide by the remaining number of shares, and if you've done it right, you should get exactly the same answer. Yep.
Suppose that also gives how much cash the company has. If we subtract that from the fair value.
That's an interesting question. You should. And here's why. Because that cash is not invested at the cost of cash. Did everybody get the question? In this problem, I just equity and debt, and there was zero cash. I didn't tell you anything about cash. But let's say I told you there was 25 million in cash. You have to take 250 plus 50 minus 25. Why? Because the cash is not invested at the cost of capital. I'm not going to get savings from the cash. I'm taking it out. When I do that, I have enterprise value, right? So that's a good point to make if you have cash netted out or use just net debt. Any questions? So this is a fair price. And is everybody clear on why it's a fair price? If I pay $31 per share, and you're the guys who sell your shares back, you're going to get $31. And you're the guys who don't sell your shares back, it's going to be worth $31. That's why it's a fair price. Everybody gets the same $6 per share. Let's say I framed the question differently. Or you decided to answer the question differently because this question didn't specify a price. Let's assume you said, look, I'm going to assume that I can buy the shares back at the old price. Completely unrealistic, but since I didn't specify it, I can't stop you from doing it. Let's see what the answer would have been. If you'd bought the shares back at the old price, here's what you're going to do first. You're going to go to the market. You have $100 million to buy shares back. You're going to buy them back at a $25 price. You're going to buy back 4 million shares. You buy back 4 million shares, you've got only 6 million shares left over because remember you had 10 million shares before you bought back 4 million. You still have a $60 million increase in value, but now only the 6 million shares that are remaining get it. The value per share will increase by $10 per share and it'll go from 25 to 35. So that's what happens when I can buy shares back at the old prices. The remaining shareholders now are going to be much happier because they're going to get they're going to get all of the spoils just for themselves. In fact, again, if you want to check your answer, take 250 plus 350, 300, add the 60, 360, subtract out the debt, you get a value of 210, divide that by 6 million shares outstanding after the buyback, you should get exactly $35 per share. Now let's make it interesting. Let's suppose I told you that the stock was bought back, not at 31, which is the fair price, or at 25, which was this old price, but at $33.33. Why? Because the banker that's a price he felt would make his life easy. Let's see how the game is going to change. First, the number of shares bought back now will be 3 million shares, right? 100 minus 33.33. They're going to be, if you subtract out the 3 million shares from your 10 million, there are going to be 7 million shares outstanding. But here's where it gets a little tricky. So let's say you're the guys who sold your shares back. You didn't sell your shares back. So I bought shares back from you. What did I pay you? $33.33, which is an $8.33 premium over the price. You multiply $8.33 by 3 million shares, that's about $25 million in value that you got from this buyback. That's the premium. What is the total value increase? It was 60 million. I've paid those guys 25 million, so all I have left for you is 35 million. I take that 35 million and divide by 7, which is the remaining shares. Your value per share will increase by only $5, which means your value per share after the buyback will be $30. So if I pay $35 per share, guess what's going to happen to the remaining shareholders? Your value is going to drop from 30 to maybe 29. In fact, there is a certain price, and this is going to be my to-do for you. There is a certain price at which you guys will end up with just the old price. So I want you to tell me, work out what my buyback price would have to be for you to wake up tomorrow and find your stock price stays at 25. It's actually in fact, we can do it right here. What has to be true for that to happen? What portion of the value would I have to pay these guys? Everything. I'd have to pay 60 million to them. So what you'd have to do is work out the algebra that'll give you a 60, which means you've got to play with both the price and the number of shares. So it's a little messy, but work it out. See what that buyback price would have to be at, which I leave you guys completely at the old value. It's not fair, but that's what happens when you pay any price other than $31. Okay. Any questions? Think of that. Whenever you have a total value, some of it goes to the people who remain in the company, some of it goes to the people who buy back shares, and you're trying, by setting the buyback price, you're altering that balance. And this is going to be, what's going to be different if I paid a special dividend instead of buying back shares? What will happen to the number of shares? Nothing. They'll stay at 10. So special dividends are actually much easier because you don't have this mess, because everybody by definition gets the same amount. So special dividends are actually, so anytime you see a problem with special dividends, it's usually more easily worked with than one with buybacks, because you don't have to worry about what's that buyback price at which I break even. So that was the third piece. Now let's talk about the final piece. And this is almost 2/3 of the exams. This is the third problem. And this is about, hey, you got the optimal, you're going to go out and borrow money. What type of debt is right for you? And if you remember, we talked about, how quickly do you have to move to the optimal and what type of debt. Here's a very simple table that tells you, that looks at the how quickly and in what form. If you're under-levered in the target of a takeover, then you don't have the luxury of time. You've got to move quickly to your optimal. You probably have to borrow money and buy back stock. If you're under-levered and you're not the target of a takeover and you have good projects, then I said you should borrow money over time and take good projects. You get the double whammy. If you're under-levered, you're not the target of a takeover and you have bad projects. How in the prom would I give you good projects and bad? Of course, I could be really open and say, this company has good projects, but I'm not going to do that. I'm probably going to give you information that should lead you to assess whether you have good projects or bad projects. So what do you think, what form do you think that would take? How would I tell you that you have good or bad projects if I don't tell you explicitly? In other words, I can say the return on capital of this company is 15%, the cost of capital is 8%. I don't have to tell you they have good projects. They have good projects. If I tell you the return on capital of this company is 8%, the cost of capital is 8%, they have neutral projects. If I say the return on capital is 4%, the cost of capital is 8%, I'm telling you they have bad projects. You're saying that's tricky. It's not. I mean, that's what this class is about, is bringing in the information by looking at the numbers. If you're over-levered under threat of bankruptcy, you've got to do something quickly. So there you've got to either issue equity, sell off assets, do desperation. It's desperation time. You've got to do whatever you can. If you're over-levered and you're not under threat of bankruptcy and you have good projects, I said take those good projects with equity. Retain earnings, and over time your equity will go up. And if you're over-levered, you have no bankruptcy threat and you have bad projects, then you've got to figure out ways to pay the debt down with retained earnings over time and bring your debt ratio. So when you look at the actual and the optimal, the questions I want to ask you is how quickly should we move it there? You have to look for clues on threat of takeover, threat of bankruptcy. And what should I do? Look for clues on whether I have good projects or bad projects. In other words, put yourself in that framework and tell me what the right thing to do for your company is. Now, last class we did all those macro regressions, and I know it kind of freaks some of you out, but it shouldn't, because basically these were simple regressions, and I said reading the coefficient, the key number is that coefficient in the number. So let me summarize the 4 regressions I ran. The first is I ran a regression of firm value and operating income against changes in interest rates. Remember that? And I said that coefficient, if it's negative, tells you what the duration of the assets is. So for Disney it was minus 2.33, and I said that means your assets have roughly 2.33 years in duration. If it's positive, God only knows what it even tells you. So if it's negative, it gives you duration. If it's positive, you can either assume that the duration is very low or the regression just blew up on you. Then we ran a regression of firm value against changes in GDP. What does that tell you? It tells you whether your company is cyclical. If your coefficient on GDP is a big positive number, you have a cyclical company. If it's close to 0, you have a non-cyclical company. If it's negative, you have a counter-cyclical company. Then we ran the regression against inflation. And I said if the coefficient of inflation is a big positive number, it means you have pricing power. If you have a big negative number, it means you have the opposite of pricing power. If it's close to zero, it means you're kind of no man's land when it comes to inflation. Why does it matter? If you have pricing power, you're a much better candidate for floating rate debt. And the last regression we ran was against the dollar. And the coefficient there is a big positive number. A stronger dollar helps you. If it's a big negative number, a stronger dollar hurts you. If it's close to zero, you're unaffected by what happens to exchange rates. So it's all about reading the regression. I'm not going to ask you to run the regressions, but I might present you with 4 regressions and say, hey, what are you going to do with this stuff? Tell me what kind of debt is right for this company. And I need you to be able to read those regressions. But here's, Abby?
Delta V is the change in firm value.
I'm sorry?
Is that what that means? It's the
Change in delta V is the change in firm value. Delta OI is the change in operating income. Now here's the last part of every quiz. And this actually should be a throwback to the last part of quiz 1. Remember we did bottom-up betas? 2 rules with bottom-up betas. They're always weighted averages, right? And the asset side beta and the liability side beta should equal out. In other words, it's weighted average. Same principle applies when you talk about duration for debt. The duration of a company's assets are a weighted average of the durations of all of the different businesses in. And the duration of its debt is a weighted average of all of the different types of debt it has. And almost every single problem plays off that theme. So let me give you an easy version of this problem. It's a problem from, I don't know how many years ago. First thing I give you is I give you a regression. So how do you read that regression? What does it tell you about the duration of the company's assets? I said take the coefficient on the regression, which is -5. Take the sign out, and the duration is whatever you get, which in this case would give you a duration of 5 years. Then I say this company has 2 types of debt. A $100 million zero coupon bond with a 2-year maturity. You know the nice things about zero coupon bonds is when I give you the maturity of the bond, I've also given you the duration of the bond. Otherwise, if it's a regular bond, I have to give you the duration explicitly because the maturity is not the duration. Then I said the other bond they're planning to issue is also a zero coupon bond for $150 million, but they haven't decided what maturity/duration to give it. But here's the question. If you want the duration of your debt to be equal to the duration of your assets, what does the duration of that $150 million in debt have to be? What's the duration of my assets? It's 5 years, right? So I have 5 years as my duration of my assets, so that's what I want to equate it to. I already have $100 million in debt on which I have a duration of 2 years. I have another $150 million where I don't have a duration. I'm going to solve for it. You're saying, I thought I'd left algebra behind in 9th grade. Algebra is never left behind. Your life is always an equation. There's always an unknown. In fact, pray and hope that you have one equation, it's only one unknown. Life actually makes it 2 unknowns with one equation. So this equation, you have only one unknown, and if you tell me, look, I don't remember enough algebra to do this, I have no sympathy for you. Hey, come on, it's algebra. You should be able to work it through. The duration, if I solve for it, is 7 years. So this was a relatively simple problem because all it meant was reading the equation for the assets and making sure you read it as. Here's a more complicated problem. So here again, the problem looks like the other problem. So in fact, it was in the quiz right after the previous quiz, so everybody read the previous quiz and so they read the first 4 lines and say, guys, I asked the same question again. And it looked like it started the same way. I give you an equation and I give you the duration. But here's where the problem is different. The company has 2 types of debt outstanding, a 1-year $200 million bond issue with a duration of 1 year, and a 5-year $100 million bond issue with a duration of 4 years. It also has 70 million shares trading at. You're saying, why is he giving me the market value of equity? This problem is a debt problem. You're going to see why. It's planning a new issue of bonds, just like the other company is. But this time, it's going to use that $250 million that it gets from the new issue to enter a new business, the online retailing business. And I say, by the way, the duration in that business is only 1 year. Okay, so let's do this a step at a time, just like we did betas. In betas, what's the first thing we did whenever we had those bottom-up beta problems? We first computed the unlevered beta, right? The beta of the assets. I'd suggest you do the same thing here. The first thing you want to compute is the duration of the assets that you will have after the acquisition. What did I say about betas? They're weighted averages, and I said durations are weighted averages as well. So let me start with the existing business they're in. What's the duration of the existing business? 7.5 years. What's the value of the existing business? 300 is just the debt. Now do you see why I gave you the market value of equity of the company? It's 300 plus 700, which gives me $1 billion in the existing business with a duration of 7.5 years, plus 250, which is the new business I'm buying with a duration of 1 year. The duration of this company after the acquisition will be a weighted average, which is 6.2 years. I'm almost home. Now what I have to solve for is what the duration of that $250 million bond issue has to be, that's the X, to get a duration for my debt equal to 6.2 years. And I solve for that, the duration of my assets is 11.24 years. But the way we approach this problem is actually the standard way you should approach all duration problems. Always start with the asset side, work out the duration of the assets. If anything is changing there, and I do all kinds of things in these problems. In some of the problems I divest a business, and others I acquire, just like I did in the bottom-up beta problems. So you got to get comfortable working out what that duration will be after the change. And then I will have something on the debt side, so what do you need to do to get your debt back in sync with the assets? And that's almost always going to be an algebra problem, where you set up the equation, you solve for the duration of whatever those assets is. Okay? Any questions? So that's about it. I will see you on Monday then.
So basically, you're one day bought one stuff and the other one day invested in that system. So here when you calculate the number of shares bought back, you're dividing 1,000 by the buyback price, but they borrowed an additional 2.
Yeah, that's nothing to do with the buyback, right? So they bought $2 billion, but there was only $1 billion for the buyback.
Oh, so it's the one they use for the buyback.
Right. To the other billion.
Okay.
You multiply the interest rate by the dollar debt. I give you the new interest rate you will have.
New interest rate. So 8%.
Multiply that by the new debt you will have afterwards.
Oh,
600 million, right?
okay. Thank you.
Just a quick logistical question. For the last quiz I had, I was sick and I emailed you, but I just wanted to make sure you never responded just to make
That's
sure.
okay.
It'll be fine. So this one would be 20% instead.
No, it's not going to be 20. It's going to be 12 and a half, and your final is going to be 37.
Oh, great. Okay.
Okay, so what I do is I move it to the remaining exams. It's not to the last quiz.
Okay. So it'll be the okay.
So basically, it will not be 20%.
Okay. Thank you.
Mm-hmm.
That's the logistical. Thank you.
Yeah, please come up with me. Yeah. Okay. Mhm. Yeah. Hi.
Question, should I ask now or?
Yeah, go ahead.
It's regarding the second question that you gave us.
Yeah.
I was just wondering, why does EBIT stay the same?
Because you borrow money to buy back stock or pay dividends. You're not investing in projects. It's the same project. Right? So it's the same. The assets out of the balance sheet stays the same. I have exactly the same assets I had yesterday. All I'm doing is borrowing money and buying back stock. That's why it's called a
I see. And the second question was, for that same question, why was it 9% specifically? I understand
because the spread was 2%. The risk-free rate was 7% in the problem. So basically, you had to add so remember, I computed the new rating to be triple B,
Yes.
and the triple B went with a 2% default spread.
That's what I didn't understand why you added. It was from 8 to 9.
But the 8 was at a level of debt where the default spread was 1%. It wasn't 0. You're not going from 0 to 2, right?
2 to 1 to 2.
Yeah, so it's going from 1 to 2,
So I have to
right?
look at the rating of it and then compare it by rating
Exactly,
now.
exactly.
Okay, thank you.
Mhm.
10%. So I mean, okay, so I just made up this example. PV is coupon, future rate, and then R would be yield.
So this is what will be. So what you will do is,
What would be the cost of that?
You have, in this example, 4 plus
come up with the 4s and 100?
4 is 8% of the coupon. So you get $4 in coupon.
Ah, and then this is equal to
No, this is 50. I'm sorry, 50 and this is 55. 55, 4, 4, 4, 50.
And
And then it's all.
R would also be the cost of production. Okay. And the other thing is, I don't understand how so like the example you had is like a change in firm value is 0.16 minus 5, I don't know, times long-term bond interest rate. Or like the example about duration, there was like an equation 0.16 minus 5 interest rate.
That works out from the algebra. Just work out the complete equation, right? Weight times the duration in each side. So the 0.116 must have been, I don't even remember what that number is, but it's coming from the weighted average, the algebra of the equation, which is the weight.
I don't understand, how is this related to duration? Because like from the equation, it would seem that it's showing how sensitive firm value is to changes in interest rate.
Yeah, that's what duration is. So
Oh,
go
that's
back and
the
review it
duration.
because in a sense, that's what duration is, right? For a given change in interest rates, how much is the bond price change? Is the duration of a bond. So if I tell you for a given change in interest rates, how much the firm value changes, I've given you the duration of the firm.
Okay.
So duration is a measure of how sensitive your value is to changes in interest rates.
Yes.
And that's basically what the regression is.
Oh, okay. I think I have to revisit this part. Fortunately, the lecture is online. Okay. Thank you.
You're welcome. Take care.
Thank you.
So now you know where Paul's was.
I have one question regarding the two tables in Davis in regards to optimal debt. What if it's unlevered but not a target table? What that means
That you have luxury of time and you're done. That was the second one.
will you give me the project detail or?
I'll give you some.
Okay, I see. And then the pricing power aspect of it, that depends on whether
Use floating rate debt. So if you have pricing power, you can use floating rate debt because you're more able to.
fixed rate.
If you don't have pricing power, then use fixed rate.
Thank you. Thank you very much.
Okay, take care.